Hello SS1 commercial students, you're welcome to class. In today's lesson, we are going to be treating the topic banking. By the end of the lesson, you should be able to define a bank. You should be able to state the types of banks. You should be able to explain the origins of banking. You should be able to explain a central bank, the functions of central bank, and how they control commercial banks. And also, you should be able to explain a commercial bank, their functions, and their futures and the types of accounts. Let's start. Now, banking. A bank is a commercial organization that is engaged in the saving of valuables, money, accepting of deposits, and lending of loans. A bank is a commercial institution or is a business establishment that save money and other valuables for individuals, accept deposits, and also give out loans to individuals. Now, banks can be classified into um, banks can be classified into the following. You have one, commercial banks; two, the central bank; three, merchant banks; four, savings bank; five, development banks; six, microfinance bank; and seven, mortgage banks. Now let's look at the types of banks that we have. One, commercial banks. A commercial bank is basically designed to function in accepting of deposits and extending of credits to members of the public. They also perform other functions excluding that, which involve discounting of bills of exchange, um, foreign exchange functions, and some other ones. The central bank is the apex financial institution in any country. Their function is to monitor other financial institutions in the country and ensure safe practices of banking practices in the country. The next one is the merchant bank. The merchant bank is a bank that provides short, medium, and long-term loans. They accept large deposits and discount bills of exchanges. They are clearing houses for commercial banks, basically. Savings banks. Now, savings bank are more like your microfinance bank. They are established for low income earners. They help to provide short-term loans for traders to engage in trading activities. The next one is development banks. Development banks are basically financial institutions that provide long-term loans in order to execute capital projects. Example is the African Development Bank. Origins of banking. Now, banking originated uh, in the same way as money originated. It originated from the practices of the British merchants when they accepted gold deposits for receipts that were issued to British merchants. The goldsmith accepted gold deposits, and in turn issued out receipts to British merchants. As time went on, these receipts that were issued out by the goldsmith to the merchants later became paper money. The goldsmiths later became bankers, and the issuing of receipts marked the beginning of commercial banking. And that's why till today you have something like the bullion van. You have something like the vault, which was used to store gold reserves by the goldsmiths from the British merchants as at that time. And that's a summary of the history of banking. Functions of the central bank. Before we go to the functions of the central bank, let's quickly look at the Central Bank of Nigeria. The Central Bank of Nigeria is the apex financial institution in Nigeria, which is charged with the day-to-day functions of managing and controlling the nation's financial affairs. The central bank guides the day-to-day activities of money and involves in regulating the activities of banks in the country and also managing the country's financial affairs. Now, basically, what are the functions of the central bank of any country? Now, number one, they are bankers to the government. They help government to keep their own money and other financial assets. Two, they are bankers bank. That is, they are bankers to commercial banks. Commercial banks have money reserves or legal reserves kept with the central bank in case when there is a need to inject more liquidity into their banking. Number three is issuance and control of currency. The central bank is charged with the responsibility of issuing currency into circulation, and an aspect of the central bank is involved in the printing and minting of currencies, and they also regulate the circulation of currency within the country. Number four, they are the lenders of the last resort. When um, commercial banks are in need of quick cash, and if they are cash strapped, they can always approach the central bank for loans. Then they are agents, or they are foreign exchange agents, or basically they are engaged in foreign exchange transactions. They help to exchange foreign currencies, and they help to regulate the trading of foreign currencies within the country. And finally, um, they formulate uh, they formulate and regulate policies guiding banking industries within the country. The whole banking industry within the country is monitored and regulated by the central bank. So those are their basic functions. Now, I haven't talked about that. How does the central bank control or monitor the activities of commercial banks? That's what we are going to look at right now. Now, number one is called open market operation, OMO. Now, open market operation refers to the sale and purchase of government securities, especially bonds, treasury bills, and treasury certificates, by the central bank from the commercial bank. It refers to the sale and purchase of government securities uh, between commercial banks. Now, this is done in order to control currency circulation in the country. When there is excess money in supply, the central bank will um, will buy securities from commercial bank. When there is excess liquidity or money in circulation, the central bank will sell its securities to the commercial bank. When they sell securities to the commercial bank, they mop up money, they collect the money with the commercial banks, thereby reducing money in circulation. Recall that when there is excess money in circulation, it can cause inflation. So by reducing the money circulation, it helps to curb inflation. And in order to induce productivity and solve the problem of deflation, central bank will um, will sell securities, will buy securities rather from commercial banks, thereby giving them money. Liquidity ratio or cash reserves. Now, cash ratio, liquidity ratio, or legal reserves. Now, this legal reserve refers to the amount of money that commercial banks are required to keep with the central bank. Now, every commercial bank is required to keep a total sum of 20 billion naira with the central bank in order to maintain their cash flow, and especially in terms of cash trap. When commercial banks do not have money, they can always meet the central bank through their legal reserves in order to inject or infuse money into their business. So when central bank increases cash ratio, it reduces money supply, and when central bank reduces cash ratio, it increases money supply. Bank rate is the amount that central bank charges commercial banks for helping them to discount their bills of exchanges. If bank rate is high, legal reserves will be if bank rate is high, money supply will be low, and if bank rate is low, money supply will be high. Special deposit. Now, special deposit is an amount that commercial banks can be required to keep with the central bank aside from the legal reserves. This is done in order to induce commercial banks to save more and also to reduce money supply. Then special directives. Central bank can give special directives to commercial banks on policies that can help to improve the financial sector. Then the last one is moral suasion. Moral suasion. Moral suasion refers to a plea or an appeal that central bank gives to commercial banks in order to follow banking guidelines set out by the central bank. I haven't talked about that. Let's look at commercial banks. Um, a commercial bank is referred to as I said earlier, a financial organization that basically keeps money for, that is, accept deposits, give out loans, and also help to discount bills of exchange. Enough said. Functions of commercial banks. Number one, they help to accept deposits. Commercial bank accepts savings and deposits of either money or valuables from members of the public. Two, they are lending agents. They help to lend money to customers that are in need of cash. Then they help to save valuables like documents, land documents, diamond, precious metals, and so on. Then they help to discount bills of exchanges. Now they help to discount bills of exchanges to their current account holders, who are basically traders. When current account holders do business and they are in need of cash, probably maybe they have a loan to offset, they can meet with their commercial bank to help them to offset their bills of exchanges, and the commercial bank will in turn um, charge them a rate, an interest rate on their services. The next one is their agent of payment. You can make payments for most things through the commercial banks. For example, you can pay for your JAM form through the commercial bank. Then they are agent of foreign exchange transaction. They help to exchange foreign currencies and help in they basically help in foreign exchange transactions. Having said that, let's look at the types of accounts that are kept with the commercial bank. Number one is current accounts. Current account is basically opened by traders. They are accounts which there is frequent withdrawal. There's no limit to the amount of money that can be withdrawn in a day. Then um, then it's easier to obtain bank loans with current accounts, and payments are made through check. A current account holder is given a checkbook which he can make payments into his account with, and he can also issue the checkbook to his customers, in which customers can withdraw money from. There is frequency in the withdrawals of accounts. The customer is not entitled to interest on his account. He is only charged for using the account on a monthly basis. So no matter how much a current account holder has in his account, he is not entitled to any form of interest. Savings account is basically maintained by low income earners. It encourages savings. This account is entitled to interest on the amount deposited over a period of time, usually a year, so usually a month, and customers will can accumulate their savings over time. Now, in savings account, the moment you make withdrawals more than 2 times within a month, you are not entitled to any interest on the amount that you have deposited in your account. So you have a maximum of 2 times that you can withdraw from your savings account in a month. If you withdraw the third time, you'll be charged for using the account after a month. Then fixed deposit account or time deposit. Now we refer to fixed deposit as an account that encourages people to save for a fixed period of time, usually 6 months or a year. So with fixed deposit accounts, the account holder can maintain an account in which he can save money over a fixed period of time, which also acquires interest on it. So there's interest on the amount that you have saved in your account. So I haven't run through basically what we looked at. We said that we looked at banking, the history of banking, the types of banking. Remember, I made mention that we have basically 6 types of banks. You have commercial banks, central bank, development bank, mortgage bank, savings bank, merchant banks. And we also made mention of commercial banks and central banks. So basically, we've come to the end of the lesson. If you have questions, you can post in the question and answer section. And have a wonderful day. Thank you.